Ever wondered how interest rates affect your wallet? Well, these rates are like invisible hands that help shape the financial world. They can impact everything from your personal savings account to the global economy. Today, we're going to tackle a topic that's crucial for anyone even remotely interested in finance: interest rates. More specifically, we'll decipher the difference between lending rates and prime rates. So, buckle up for an enlightening journey through the realm of finance. Stay tuned as we dive deep into the world of lending rates and prime rates. Scene script. Interest rates, they're everywhere, but what exactly are they? Well, to start, think of interest rates as a price tag. It's the price you pay for the use of someone else's money. When you borrow money, you pay interest. When you lend money, you earn interest. Interest rates are expressed as a percentage of the total amount borrowed or lent, often referred to as the principal. For example, if you borrow $100 at an interest rate of 5% per year, you'll have to pay back $105 after 1 year. Interest rates are not just arbitrary numbers, they play a crucial role in our economy. Central banks like the Federal Reserve in the United States use interest rates as a tool to control economic growth and inflation. When the economy is booming, they might raise interest rates to prevent overheating. Conversely, in times of economic downturn, they could lower interest rates to stimulate spending and investment. But how do interest rates affect you and me? Well, they directly impact our finances in a number of ways. If you're a saver, higher interest rates mean your savings will grow faster. If you're a borrower, higher interest rates mean you'll have to pay back more on your loans. Interest rates also influence the cost of our mortgages, car loans, and even our credit card bills. Even a small change in rates can mean big differences in how much we pay over the long term. Businesses are also affected by interest rates. They influence business decisions about whether to borrow money for expansion or investment. High interest rates can make borrowing expensive, potentially slowing down growth. In essence, interest rates are a fundamental part of our financial system. They're the mechanism that balances saving and borrowing, and they help steer the direction of our economy. Now that we've got a handle on interest rates, it's time to explore lending rates. Scene script. Ever borrowed money? Then you've encountered lending rates. Lending rates, also known as interest rates, are essentially the cost of borrowing money. When you get a loan, you're not just paying back the amount you borrowed, you're also paying a fee to the lender, and that's what's known as the lending rate. So, how are these rates determined? Well, they're influenced by a few key factors. One of these is the duration of the loan. Generally, the longer the loan term, the higher the interest rate. This is because the lender is taking on more risk by letting you borrow their money for a longer period. Another factor is your credit score. This is a numerical representation of your creditworthiness based on your history of borrowing and repaying loans. If you have a higher credit score, you present less risk to the lender, and so you're likely to get a lower lending rate. Now let's talk about the impact of lending rates. On a personal level, a high lending rate means that your loan will cost you more over time. For example, if you take out a loan to buy a car, a higher lending rate would increase the total amount you'd have to pay back. For businesses, lending rates can affect their ability to finance operations, expand, or even survive. A high lending rate can make it more expensive for a business to borrow money, which could limit its growth. Conversely, a low lending rate could allow a business to borrow more cheaply, potentially boosting its growth. In the broader economy, lending rates can influence everything from consumer spending to business investment. They can even impact the rate of inflation. So as you can see, lending rates are a vital part of the financial ecosystem. They influence not only individual and business decisions, but also the trajectory of the entire economy. Lending rates, as we've seen, play a critical role in borrowing, but there's another rate that's just as important: the prime rate. Prime rate. It sounds important, and that's because it is. You might have heard this term thrown around in financial circles and news, but what exactly is the prime rate? In the simplest terms, a prime rate is the interest rate that commercial banks offer to their most credit-worthy customers. This rate is typically only available to large corporations with excellent credit. However, it's not just these big businesses that should care about the prime rate. Why? Well, the prime rate serves as a benchmark for other types of lending. It's like the North Star of the financial world, guiding the direction of various forms of credit. This includes credit cards, personal loans, and even mortgages. Now you might be wondering, who sets this prime rate? The prime rate is largely determined by the federal funds rate, which is set by the Federal Reserve, the central bank of the United States. When the Federal Reserve adjusts the federal funds rate, banks usually follow suit by adjusting their prime rates. It's like a financial domino effect. But how does this affect you and me? Well, when the prime rate goes up, borrowing gets more expensive. This means higher interest payments on everything from your credit card balance to your home mortgage. On the flip side, a lower prime rate can make borrowing cheaper, perfect for those who are looking to make big purchases or investments. But remember, while a lower prime rate might sound like a dream come true, it's not always sunshine and rainbows. A lower prime rate often signals a struggling economy. It's a bit like a double-edged sword. In the grand scheme of things, the prime rate plays a crucial role in our financial lives, whether we're conscious of it or not. It's the invisible hand that guides the cost of borrowing, influencing everything from the interest on your savings account to the monthly payments on your car loan. As we've seen, prime rates hold a significant influence over lending rates, and thereby our financial lives. So next time you hear about a change in the prime rate, remember it's more than just a number, it's a key player in the financial world. So, we've traversed the landscape of interest rates, lending rates, and prime rates. Throughout this journey, we've discovered that these rates are more than just arbitrary numbers. They are the heartbeat of the financial world, influencing everything from the decisions of multinational corporations to the monthly payments on your car loan. Let's quickly recap what we've learned. Lending rates are the interest rates charged by banks and other financial institutions on loans they provide. These rates can vary widely, influenced by factors such as the borrower's creditworthiness and the overall economic climate. On the other hand, the prime rate is a benchmark interest rate used by banks to set rates on various types of loans, including personal, auto, and home equity loans. It's typically determined by the federal funds rate, which is set by the Federal Reserve. These rates are crucial in the financial world. They dictate the cost of borrowing and, by extension, influence spending and investment decisions. Understanding them can help you navigate the often complex world of finance. Whether you're a business owner considering a new investment or an individual planning a major purchase, remember, understanding these rates can be your key to making informed financial decisions. Thanks for joining us on this journey through the world of interest rates. Until next time.